Hey guys, in this video, we're going to do a brief summary of some of the key earnings reports that took place in the stock market this past week. Before getting into it, if you like this kind of content, please hit the thumbs up button. Consider subscribing to the channel. Would love to hear your thoughts in the comments as well. It really helps us grow the channel. Okay, we're going to start on Monday where Carnival Cruise Line reported their earnings. So Carnival, just looking on the week, their stock went up 6.5%. So pretty successful week for Carnival. If we look at their report and what they reported, I think we'll start with just looking at what their revised earnings per share targets are. So for current year, their estimate is to lose about 20 cents a share in terms of what analysts think they'll do. High side, in best case scenarios, it looks like they're going to be breaking even. Going into 2024, high side scenarios have about $1 of earnings. Average scenarios about 75 cents of earnings. So you look at the stock today trading at over $10, lots of debt on the balance sheet, and they're going to, best case scenario, make no money in 2023. So this is one that even if they do end up making 75 cents of earnings, you're really paying 12, 13 times 2024 earnings for a company with a lot of risk between now and then and a bad balance sheet. So this is one just at face value I still think is overpriced, at least for the time being. People who are buying the stock probably are looking at a longer term horizon and think that eventually they're going to pay off the debt, interest rate's going to go down, and they can start cranking out $2, $3, $4, $5 of earnings per share. So that's the gamble that they're taking. They're taking a company that's not really spitting out any cash flow today and hopes that in the future this will look dirt cheap. But in terms of current day valuation, it's really not there. Taking a look at their earnings and revenues, it's really interesting to see them go from $5-6 billion of revenue in 2020, because they did get that first quarter in before COVID hit, down all the way to $2 billion in 2021, now all the way to over $12 billion in 2022. It's really interesting too to see the gap, or not the gap, but the relationship between passenger ticket revenue of 7 billion and onboard the ship revenue of over 5 billion. So that means people are almost paying just as much once they get on the cruise ship as they do for their stay on the cruise ship, which is surprising to me. I feel like when I've taken cruises, I haven't spent that much money on the boat, but I guess other people do. So despite $12 billion of revenue, you can see all kinds of other costs jumping up. They still lost $4 billion, less than the last couple years, but overall, on an earnings per share basis, lost $13. That's more than their entire market cap right now in 2020. In 2021, lost $8.50. In 2022, lost $5. So that's like $27 of losses per share over the last 3 years. Lots of that sitting in debt. This one's just tough for me. But nonetheless, it was interesting to see their earnings come through, like we just looked at here, high level on the revenue side, and the adjusted expectations of them to be profitable in 2024 at least. So my thoughts on Carnival are still too rich for me, not one that I'm interested in, but I find it interesting to watch from the sidelines. Okay, Tuesday was a really big day in the market. We had Walgreens, Lululemon. Dave & Buster's is a cool entertainment company that I wanted to look into as well. So we're going to take a look into those three names, starting with Walgreens. Walgreens, when we look at them on the week, they did also go up about 5%, about a $30 billion company here, trading at about a 5.5%. Looking at their earnings. So their earnings decelerated 20% to 80 cents a share for the quarter. But what I'm more interested in is the 2023 outlook. So they're guiding between 445 and 465 of earnings per share. The core business growth more than offsetting some weakness in COVID-19 shots, since they administer lots of these shots. And they believe they will be pivoting to double-digit EPS growth in the second half of the year. So when we just look at this business overall. Yes, they had decelerating profitability in 2022, but even with that, they're still trading at 7, 8 times earnings of 2022. And now going into 2023, they're saying they're going to make about $4.50 a share. So they're trading at 7.5 times current year earnings as well. So the cash flow yield on this company, or the earnings yield, is like 12, 13% that you're getting as a return. You're getting half of that almost paid out in a dividend. The other half, buybacks or other investments they're making to grow the business. With Walgreens, you also get some international exposure because of the UK side of the business. So this stock is one. I'm not surprised it went up 5%. I am surprised it's still trading well under 10 times earnings. I know they have some issues, some obstacles, whether it's theft in stores, short store shutting down, just healthcare being a very competitive space, which they're indirectly playing in here. But I just think that given how profitable this company is, this is a very attractive share price. So this is one I continue to keep on my watch list. As it gets down, or if it gets down closer to 30, I may start nibbling in, because I just see limited downside from here. Just looking at this article here, you kind of see their healthcare unit posts a jump in revenue. Lots of their stores are starting to return to normal hours now that they're having a bit of an easy time recruiting talent, it looks like. And even though their revenues, or their profitability, jumped 20%, the number still beat Wall Street expectations. So that's why the stock's going up despite the weak number relative to a year ago that they shared. It's already been more than priced in. If we look at the stock past 1 year, down over 20% as is. Okay, the next company is Lululemon. So Lululemon up 16%. You can guess that they had a really good earnings report, trading at $365 per share here. If we look over the last year, stock's down 5%, better than the overall market. But it was really, propelled back up just this past week, up 16, 17% in the past week, another percent up in the last month. But we're going to focus on the last week here. Okay, in terms of their earnings, so their fourth quarter revenue increased 30%. Profitability was pretty strong, had adjusted EPS of $4.40, adjusted EPS on the year of $10 per share. So looking back at 2022, they're about 36 times earnings backwards looking. But when we go to forwards looking here, they're going to grow about 15% next year, and then about another 10 to 20% the year after. So if I just take this number here, they're trading at about 32 times 2023 earnings, and they're trading, it looks like 28 to 29 times 2025 earnings, if you believe the analyst expectations. So expensive stock for sure, but some of the results they're showing here are really, really strong. Growing 30% in this environment is super impressive. Direct to consumer is worth over half of their net revenues now. I found that to be insane. That for a bricks and mortar business with a big footprint, they're over 50% D2C, which if they can figure out and get scale, could probably be a more efficient business for them given the types of goods that they're selling. And those D2C sales went up 37%. So they're growing their D2C business at a faster clip as even their overall business, which grew 30%. So really strong business, really strong brand, really strong growth, very high valuation. So you're paying for it, but this is a great business. And I'm just amazed they grew 30% in the climate that we've been in over the last year, with interest rates going up, discretionary purchases going down. Not a problem for Lulu. They're still up 30% versus 2021. So congrats to them, and obviously any shareholders who had a good week in Lulu. My thoughts on Lulu: fantastic company. If it got to a better valuation, I think it would be one I'd be interested in. I've never really bought in this space before in terms of clothing and stuff like that. So I don't have it on my watch list or anything, but I just think it's a great business. So if it ever got to a price that I found attractive, I'd buy it. But I'm personally not interested at 30, 32 times earnings here. Okay, going over into Dave and Buster's. So this is a bit of a fun one. $1.8 billion company this week went up a couple percent, and it actually looked like they had some good earnings. So they announced before going to the results, $100 million share repurchase program was announced. So that's a good chunk, about 6% of their business here. In terms of earnings per share, they made about $2.80 on the year. You can see that here that I'm highlighting. So backwards looking, they're trading at about 14 times earnings. I think that's a fair-ish valuation for a company like this. And just overall, their revenue growth, it's really hard to delineate just because they've had such weak periods in the base, right? With COVID impacting their business, but you can kind of just see overall their revenue. Oops, their revenue here is up pretty substantially, quarter over quarter, year over year as well. So those are all good signs. But overall, they've been profitable consistently. Their same store sales are increasing, which is a good sign, and also their weekly sales, which I found to be an interesting measure, seems to be steady to increasing as well. So all of those are good things on the business. They've had about 25% EBITDA margins once you put back in the depreciation. So this business finally looks healthy again, not trading at too cheap of a valuation. Like, I'd rather own Walgreens at a 7, probably more defensive, than Dave and Buster's at a 14 or a 13. So I think this company stabilized a lot. Hopefully they grow from here and continue to do well. I think it's probably, fairly valued, but I feel like there's better places to put money, in my opinion. And I don't have a lot of background on this space or this company. So this is one that I'll keep watching and for fun and stuff like that. But I'm not overly interested in making a position in. Okay, and the last company here, just going back to the chart that we are looking at this week on Wednesday, was RH, which is a premium furniture manufacturer and retailer. The rest of the companies here I wasn't too interested in. If there's any other ones here that you want to talk about or you have any thoughts of, let me know in the comments. But going to RH, the stock was actually flat, slightly down on the week. And I thought they had horrible results. So let's go through this briefly. On adjusted net revenue, they're down, 5, 6, 7%, it looks like. They were flat on margins, down on operating margin, down on adjusted net income, just a $500 million. Adjusted earnings per share down pretty substantially, 26 to 20. And then just going down deeper into their outlook for next year, their outlook, they did about $3.5 billion this year, which was down versus last year. For next year, they're looking to do $3 billion. So they're expecting a 20% further hit. If you look at their sentiment, they're saying we expect business conditions to remain challenging for the next several quarters and possibly longer as a result of the accelerating weakness in the housing market, the uncertainty generated by the recent banking crisis, and the cycling of record COVID-driven sales and backlog reductions. So, they pretty much just posted really bad results, a terrible outlook, blamed it on everything under the sun, from the banking crisis to COVID to interest rates. So, yeah, I don't really think that was a great explanation of why you're going to shrink 20% next year on a year that you already shrunk 5 to 10%. So I don't think this stock's in that good of a spot. If you look at their earnings projections for current year, it's about $13 would be the average estimate. So just looking at that, they're trading at a high teens multiple for a premium furniture manufacturer and retailer who is about to go into 2 consecutive years of consistent and accelerating decline of revenue and profitability. This is one that I have literally zero interest in. I'm shocked that they're trading as high as they are. I'm shocked the stock's not down 5-10% on the week. Maybe people saw it coming already, or they've kind of hinted at this before, but I thought that was a really bad report. from what I saw. And I think this company, for what it is trading at too high of a multiple here. So that's my thoughts on this week's earning reports. My main takeaways are Walgreens, I think, is an interesting opportunity at the valuation it currently presents itself at, and the dividend that it's paying out. So that's what I'm going to keep on my watch list. Keep watching. Don't be surprised if I eventually, start nibbling in on Walgreens and Lululemon. Just from a spectating point of view, phenomenal results, great business. I wish it was a stock I could get into or traded at a better valuation, but nonetheless, was really impressed with their numbers overall. Thank you guys for watching this video, especially if you made it till the end. Let me know in the comments. Give me a thumbs up, please. Subscribe to the channel if you haven't already. Would love to hear from you guys and engage with you guys more. And I'll see you guys in the next one.